Welcome to another episode of the Financial Resource Academy podcast, where we break down the news and information that affects investors and savers at all stages of life. As a reminder, please do not take anything that we say here as specific investment, tax, or legal advice. If you hear something in today's episode that causes you to want to take some action or make some changes, please consult with the appropriate tax, legal, or investment professional prior to making any changes. On today's episode, we're going to talk about the upcoming tax season right around the corner in 2026. For our focus, we're going to look at an article from Kate Dore from CNBC. That article will be linked in the description. So thank you, Kate, for inspiring this video. She wrote an article entitled "Trump Promises the Largest Tax Refund Season of All Time. What you can expect." So at the beginning of the article, Kate reminds us that President Trump has been promising very large tax decreases for the middle class for some time now. And perhaps that will work out that way, perhaps not. There's some things that could happen that might make that not exactly work out. But for the most part, the provisions that were passed in the One Big Beautiful Bill should, in general, decrease taxes overall for the middle class. Now, Kate highlights in her article that Erica York, who is the vice president of the Center for Federal Tax Policy, she did release a statement saying that the Center for Federal Tax Policy does expect that people will get larger refunds in 2026 than they might otherwise be expecting. So refunds and tax decreases are not the same thing exactly, right? So if my taxes are lower than I was expecting and I pay more taxes, then I am going to get a larger refund. So that part's true. But that doesn't necessarily mean that taxes went up or down or whatever the case may be. The point is that we just have more people who paid more taxes in over the course of this last year than they actually had to. And here's the reason why. The One Big Beautiful Bill that was passed, that's the official name, by the way. I'm not calling it beautiful or anything like that. So, although, it's so aptly named for our current president because this is exactly what he would call it. But the point is the One Big Beautiful Bill. That's the official title of the bill. It had provisions in it that were very specifically retroactive. Retroactive means that even though the bill was passed this year, the provisions, and it was passed, not that long ago, the provisions apply for the current year. That's what retroactive means. So even though we've gone through half the year with a certain understanding or a certain expectation around taxes, when that bill passed, it implemented many of those provisions going back to January 1 of this year. So that just, a lot of these provisions were tax savings. And so anyone who was not planning on having those tax savings probably withheld more taxes either from their paycheck or maybe they paid higher quarterly taxes throughout the course of the year than they actually needed to. Some of the provisions that decrease people's taxes were higher standard deductions, okay, especially the senior standard deduction, which added an additional $6,000 for persons over the age of 65. So that's going to be a big difference for many seniors, but standard deductions overall were increased. On the younger end, those with children, many of you who are higher income earners maybe don't really get a lot of benefit from the child tax credit. However, now that child tax credit income limitation was increased. And so many people who maybe previously were not getting the child tax credit are now going to qualify for that child tax credit. So that's going to mean additional dollars that taxpayers are not actually owing taxes on that maybe they weren't planning for. And then another big one is the SALT cap taxes. So state, local tax deductions, property taxes. It used to be that you were capped. You could only deduct up to $10,000 of those taxes. That cap has now been increased. You can deduct up to $40,000 from state, local, and property taxes off of your federal income tax return. Lastly, there were taxes on tips that were removed, overtime, auto loan interest deductions. So you could actually deduct certain auto loans. And that's going to offer significant benefits for many tax filers. But this wasn't something you could plan for ahead of time. Remember, these provisions are implemented retroactively. So the reason why it is probably the case that we're going to see one of the largest tax refunds, I don't know if ever is the right word, but maybe ever, is because we implemented tax deductions mid-year and most people just didn't plan for that. They weren't expecting to get these higher tax deductions. And so most people are overpaying their taxes here in 2025. And it means that many people will get a much larger tax refund than they're expecting in 2026. So even though they're going to get a larger refund than they may have been expecting, the reality is this is just the new tax code. So what should we do in 2020? Should we always plan to get a bigger refund? No, I wouldn't necessarily think about it like that. In 2026, you're going to want to think about your taxes with these other provisions in mind. So I just want to share with you three helpful tips to keep in mind when you're planning your taxes in 2026. So not when you're filing your tax return and getting your refund. That's all, the year's almost done. So there's not a lot yet to do. One of these maybe you could still do this year, but the point is when you're planning your taxes for next year, here's three things to keep in mind. Number one, if you are thinking about making a vehicle purchase and you are planning to take a loan to purchase that vehicle, consider making sure that that vehicle purchase is going to qualify for the auto loan interest deduction. It's not every vehicle that's going to qualify. The big limitation, there's other limitations, there's some income limitations also, but the big limitation is that the vehicle does have to be an American made vehicle. So make sure when you're making that purchase, if you're wanting to plan for that auto loan interest deduction off your tax return, that you are getting that American made vehicle. Number two, there are income limitations for many of the tax provisions, but the senior standard deduction provision, so they added this $6,000 senior standard deduction. It's from now through the year 2028. Seniors need to be mindful that there are income limitations to taking that deduction. And so when you're considering things like a Roth conversion from your IRA account, moving money over into your Roth IRA account, those conversions are considered income and could affect things like receiving yes or no this extra standard deduction. So do keep that in mind when you're planning your taxes for next year. The other thing is if you have significant state, local, or property taxes, you can now deduct up to $40,000. So if you have a year with significantly higher income, maybe due to some investments or you got extra bonuses from work or something like that, it may be worthwhile to you. Let's say you have a January tax payment coming up, pay it in December. Right? The tax deduction is for when you make the payment, not when the tax is due. So you could, if you say earlier this year you paid your property taxes in January, you made your summer taxes, and now you have another winter tax that's going to be due next January next year, maybe pay it this year. Then that'll lump sum it up you'll get an extra tax. So if you got an extra bonus this year, you had, an investment property that you sold, or you had some extra capital gains that were realized in your investment accounts, that could be a way to help offset some of that tax exposure. Now, again, if you do it this year, then you lose that opportunity for next year. So you got to keep that in mind. But that higher limitation of $40,000 rather than $10,000 is what it was before, could be some significant tax savings available to you. So do keep those things in mind. Okay. Thank you again for joining us for today's podcast. If you would hear something today that causes you again to want to take some action or make some changes, another reminder, please, this episode is not designed to be specified tax, legal, or investment advice. If you hear something that causes you to want to make some action, take some action, or make some changes, do consult with the appropriate tax, legal, or investment professional prior to making any of those changes. And with that, we'll wrap up for today, and we'll see you next time.